Make sure to record.
Filling up pretty quick there. Can you see that attendee? 55, 50, 61. There you got people flooding in.
Sweet. What's up, y'all? Welcome to tonight's webinar. We're excited to have everybody here. We have myself, Tyler Devereaux. We have Ryan Wooley. We also have Jackson. I'm sure Jackson, Tasha, Melissa. But Ryan and I will be doing the bulk of everything today and walking you through the webinar, which is all about financial freedom and how you can obtain financial freedom. So most of y'all know who we are, but if you do not, for whatever reason, it's nice to meet you. Hello. My name is Tyler Devereaux.
Hang on, Tyler. Hang on. We got people saying aloha. You live in Hawaii. You've got to give a proper hello.
Hey, aloha. Aloha, Gil. I love that. So there we go. So my name is Tyler Devereaux. Once again, live here in Maui, Hawaii. One of the managing partners of Multifamily Capital Partners. And here with Ryan Wooley, who's the other managing partner, co-founder of the Multifamily Capital Partners. So we're excited to have everybody here. The purpose behind the webinar today, okay, we're going to dive right in and get right into the meat, right into the content, okay? And if you have questions throughout, you can certainly ask them. We have the team here to help guide some of those questions. We'll open it up to a Q&A at the end. But man, listen, the purpose of the webinar is to help you maximize your investment opportunities so that you can obviously achieve financial freedom. That's what everyone is here looking and wondering how to accomplish this, right? I would imagine is what we're all working towards. And so to do that, though, you need to understand a couple things. You need to understand the pros and the cons of the investment, the current investment landscape, which we're certainly going to walk through. You also need to understand how to diversify your investments, how to structure with growth to grow your investment and also protect your investment. So to do that, you need to understand, and this is key for you, okay? You need to understand the difference between a typical syndication and our investment fund, the Akahi Fund, and how we've structured and why we've structured, why we've decided to structure the way that we have. Okay, so what we're going to walk through today is a couple things. We're going to explain some past properties that we actually just exited. One of the most common questions we get asked is just to help people want to understand past performance and what one of these properties look like from start to finish and projections versus actuals. And so we're going to walk through those kind of things. So these are 4 properties that we just exited in the Carolina market. And Ryan, I don't know, we can dive into, what those details are, but we let everybody know when we acquired these properties and kind of the high level details of the portfolio.
Yeah, that's great. So first of all, it's good to be here. It's the last time Tyler and I did one of these, I was in Hawaii. So it's a little different. I'm in Florida now. So we couldn't be, that much farther apart from each other. So, but I had to wear, first of all, I had to wear my Hawaii shirt, because I miss Maui already. So, so a little bit about these properties is, Tropical Ridge, as you can see, number 1 there, we acquired, about 18 months ago, and man, this is just a sweet little property. It was a property we got that's, one of the things we'll talk about is we like to buy mismanaged properties. We see a lot of operators, a lot of owners out there go acquire these properties and don't know how to manage them, right? They don't have the background to do it. They think it's great, mom and pop, and they completely mismanage it. This Tropical Ridge was awesome because one of the owners, I won't say this is awesome, but one of the owners is actually a tragedy. He passed away, but the other 2 owners didn't know how to operate it. We were able to come in with our team and really just take over. We'll go over the returns on this in just a little bit, but Rivercrest was an awesome purchase as well. One of the things I remember on Rivercrest.
Something real quick, Ryan.
Yeah, go for it.
Because what I was going to mention is we picked up Tropical Ridge. We picked up this first property, Tropical Ridge. You'll also see it labeled Charbonneau Apartments. We bought it as Charbonneau Apartments and then rebranded it to Tropical Ridge. So they're the same thing, but we bought that and got this and started this acquisitions process on this property in June of 2020. So in the chat, you tell me what did the economic outlook, the environment look like in June of 2020? Stable or unstable? scary, sad, unstable. Okay, so how many of you look at the current economic environment right now and think that it looks scary, sad, and unstable? Give me a yes if you do, a thumbs up, a thumbs down, a yes, a no, whatever. Lots of yeses. Okay, this is why I want to point this out. Think about this. So many people in 2020 were sitting on the sidelines because this same fear that's, that is we see in the thread keeps people on the sidelines. We didn't stay on the sidelines. We went full bore into pushing the gas pedal down, and you're going to see what that meant for our investors. And what that will mean for you, as long as you align yourself with the right team of people to help you with your passive investments. How many of you are here today because you are actually interested in investing passively into multifamily apartment deals? Give me a thumbs up, thumbs down, yes, no, however you want to. I would imagine that's why you're here. Okay, and if it's a thumbs down or a no, just go ahead and click the leave meeting. It's probably not a fit, probably not a fit. It's what we talk about. It's what we do. It's why we're going to help you understand not just that you should, but why and how you should do it. That's key. So we're always asking ourselves as operators, I want you to understand why we exited these properties, and I'll turn it back over, Ryan, but we exited these properties because we're always asking and trying to understand, how do we mitigate risk while maximizing returns? How do we mitigate risk while maximizing your returns? That's what you want your operating partners asking, but not just asking, being able to answer. And the answer to that question is why we decided to exit when we did. And as a passive investor, listen, your job, you've already done your job. Your job, really, you've already worked hard for your money. And so now your job is to put that money to work so you don't always have to work, right? Our job, like I said, is to protect and grow your investment capital. That's our job. So how we did that on these investments and these properties, a couple ways. Solid operations. Solid operations. What I mean by that is both the buying aspect, how we bought them, when we bought them, how we negotiated that. Ryan Wooley gets every ounce of credit for how we buy, because he's the person who looks at all the numbers, helps dial in the business plan, and then improving operations, improving the asset once we bought it. So if we can buy properly and then improve, once again, the operations that he's just talked about, the values are awesome. So solid operations is number one. And number two is forecasting. Ryan Wooley is also the one who gets a ton of credit for forecasting. We obviously have a team of people. It's not just Ryan and I. It's not just Ryan, Melissa, Tasha. We have an entire team, multiple offices, one in Orlando, one here in Maui, where we are looking and forecasting all the time. So we forecasted back about a year ago the quick rise of interest rates. Interest rates were at an all-time low. We knew that they would increase. How did we know that they would increase? Well, nobody knows everything for certain, anything for certain. Nobody. But we can make educated decisions based on past knowledge, past track record, past experiences, right? Same way that you make decisions in your own life because you have experiences is the same way we make decisions on these properties. Why? Because we have experiences. We've experienced it, right? But we also know that the landscape is always changing. And so we're forecasting what is going on. And, the ability to forecast the rise in interest rates we knew that would ultimately affect our exit price and investor returns. And so because we were able to forecast that, because we were able to understand that, we put a plan together to exit quicker than we initially anticipated. And be able to exit, get a good chunk of capital back to our investors, returns back to our investors. But what do we want to do with that money? Do we just want to return it? What do our investors want to do with that money once they get that? What have they done with that money, I guess is what I should say. Do you think they just put it in their bank account and chill? Yeah, Leon, they reinvest, Brian, they grow, right? It's all about reinvesting and growing that capital, growing that, right? So with that in mind and being able to, but not a 1031 exchange. So this is what's very interesting. I think it's Dorica. I can't see the chat very well. So I apologize if I mess up some names, but we talked about a 1031. And if you don't know, Ryan, why would typically people want to do a 1031 exchange?
I think that most people, want to do a 1031 exchange because, listen, it's all about deferring your tax liability, right? And that's what we're just taught growing up. I mean, it's been one of the best ways for a long, long time to defer paying taxes, especially when you sell big properties like this. You look at the gain on this, and $7-8 million could kill you tax-wise, right? And so a lot of people are just taught that their whole life, I mean, at least for a long time now. So, there's what happens is a lot of people don't educate themselves on the different things that you can do on investment properties. And that's exactly what, Tyler, our team does, is we're constantly going out there and looking at the tax breaks for, for our investors, those who invest with us, the benefits. Why do we do that? Here's the thing. We invest alongside you guys, right? And I think that's what's great about it, is we're investors in these properties with you guys. We want our money to work for us, and so we're always looking for, the tax benefits going on out there. And I don't know if you want to talk about it, but, we can talk about cost segregation and bonus depreciation. This year is the last year for 100% of bonus depreciation. And for those of you who don't know what it is, I don't know if Tyler, if you want to go over it, or if you want me to do a quick little one of it, but you want to talk about it, or you want me to talk about it? Or
I'll explain it like this real quick. If you were a farmer, okay? If you were a farmer and you had to pay taxes on the seeds that you plant or taxes on the harvest afterwards, what would you prefer to pay taxes on? Obviously, whatever is smaller, whatever is going to limit, which is seeds, Cassandra, you nailed it, which is going to reduce your liability. Well, we don't know what tax rates are going to, no, harvest is not the right answer. It's not the right answer. Now, let me tell you what some of you with the 401k will be doing. You are going to be paying taxes on your harvest. All that money acquires, if you have $1 million in a 401k, that money is not yours. About half of that will be yours. You want to know why? Because you're going to pay taxes upon the end, and those tax rates are probably going to increase. Why do we expect those tax rates to increase? Well, what's our national debt doing? Is it increasing or decreasing? It's increasing. And if our national debt is continually increasing because we're printing paper, well, then guess what's going to happen? Probably taxes are going to go up. So think about this. Your job as a passive investor isn't necessarily to do all this research, but our job as operators is absolutely to do that research all the time, because we need to be the ones that are educated in helping you not only make money, but once again, protect your capital, grow your capital. So what Ryan's talking about with bonus depreciation, cost segregation, it is a way to defer your taxes or offset your taxes, offset your taxes. So you can cash out, offset the taxes, reinvest, get more tax liabilities, and pay very little in taxes because of the things that are in play. Now, right, I don't want to necessarily get into those exactly right now. I'm going to get into them in a couple slides. I want to go through very quickly, just bullet point some of these returns. Are you okay with that?
let's go for it. Yeah.
Okay, let's go through it together. Okay, so we're going to go into some of these property trends. So Charbonneau, just to help you understand, Tropical Ridge is what you'll also hear it called. We bought this in June of 2020, closed November of 2020. Okay, help you understand some of the costs here. We purchased this property. If you'll switch the slide for me, there we go. Purchased this property for $7.5 million, 138 unit property, by the way. Purchased for $7.5 million. And we had projected annualized rates of return of 19.65. And then if you look at our exit price was 14.7 million. And our actual return, ARR, if you see ARR, that stands for annualized rate of return, okay? Annualized rate of return. And Tony, we have all the financials. I'm not going to go through the proof of all the financials because everyone on this call would go to sleep. And my job is to make sure that you do not sleep. But if you want it, we have a whole breakdown of all of it, my man. Not even a question. So once again, exit price 14.7, actual annualized rate of return 47.42, projected 19.65, actual 47.42. Pretty good, yes or no? Once again, though, I want to just paint this picture. When did we buy this property? We bought this property and started the acquisitions portion of this property in June of 2020, when so many people were nervous, scared, unstable of the market. When you understand what to look for and you understand how to focus on the controllables, you don't have to be scared. You don't have to be scared. You can actually benefit from the environment instead of staying idle and having it be a detriment to your financial environment. That's Charbonneau. Now we have Rivercrest as well. Rivercrest we bought in January of 2021, okay? January 2021. This property is 150 units. We purchased this property for 10.3 million. Projected annualized rate of return of 18.17. We exited that property for 15.9 million for actual annualized rate of return of 31.84. Not too bad. Hey, Rye, one more thing with the properties and the returns. How long did we hold Charbonneau Apartments for, or Tropical Ridge, Charbonneau, the first one?
Yeah, 18 months.
Okay, and how long did we hold Rivercrest for? 13 months, right?
16 months, yeah.
Yeah, 16 months. You're right. Sorry, my bad. 16 months. So once again, these averaged annualized rates of return, the value that we were able to increase, need you to understand, all of them were under 2 years. Now, those are not the only ones, okay? We also have Windridge Apartments. Windridge Apartments, 46 units, purchased this for 3.7 million. Projected annualized rate of return, 19%. And our actual numbers, we exited for 6.1 million, which gave our investors returns of 25.47%. Donald asked what improvements were made during that time. Improvements on these properties consist of two areas. Okay, you have organizational side, and then you have actual construction capital improvement side. And a lot of improvements were made on the organizational operational side. That is our bread and butter. And we also absolutely put money into the exteriors and interiors. So if you're looking at what the actual price is, right, this 3.7 and we exited for 6.1, just so you know, those numbers really don't mean too much because you have to look at the returns. What rate of return did we actually get to our investors, which is where the 25.47 and all these other numbers that we've talked about. That's Windridge, that's 46 units. Last one that we acquired in this portfolio, Prosper Fairways, September of 2021, 419 units. We picked it up for 34 million. Projected annualized rate of returns to our investors of 18.63. We exited that property for 44.6 million for projected annual and actual annualized rates of return at 32%. 32%. I just saw that Tasha had put a link in the chat as well. Tasha, Melissa, John, they head up our investor relations department. And if you would like to schedule a call with them and chat, obviously click on that link and they can help you understand opportunities that we have. But all these returns, once again, I want to paint this picture. If you look at the whole portfolio, okay, average hold time right around 1 year-ish. Okay, some were as little as 6 months, some were 18 months. Okay, at the high end. Average annualized rate of return, 30.49%. Average projected return, sorry, thank you, Ellie. We held Prosper Apartments for 6 months. 6 months is correct, right? Right?
Ended up being 9 months. We put it under contract at 6. Yep.
9 months, sorry. 9 months. And then, so we projected returns to our investors on average for this portfolio of 18.86, when in reality we hit 30.49. And we created over 37.5 million in equity on these projects. Okay. Think about this. I just want to paint this picture before we dive in a little bit deeper. Okay. These properties were bought in a time where most of you would say that it was unstable. The future was not looking very good. There's fear in the market. Once again, I just want to paint that picture. Right? Is there anything else you want to talk about here?
Oh man, I'm on the spot here, huh? Yeah, no, I think that you're heading down right the spot that I would talk about, is I think it's a great time right now. I mean, I was just looking at Tropical and thinking back on that, and I know a lot of people don't like to talk about politics. I mean, you just talked about factors and historical. I think Dodie or someone on here just mentioned historical data, right? And the thing is buying in November 2020, what was happening? Obviously someone asked me the other day what your political view is. And I said, I don't get into politics. I just don't get into it. However, I love Republicans and I love Democrats. I love both of them. Why? Because when we buy, I know you're going way off in a completely different way.
No,
right?
I'm not. I'm saying you're a total politician right now. I love Democrats. I love Republicans. You are a politician right now, Ryan.
I love them all. I love them all. You know, but the reality is November 2020, what happened? Rates were extremely low, right? I mean, you know, our rates are at 3%, which is great. I want to go in and I want to sell properties when Republicans are in office. When Democrats get in office, I want to buy, man. I want to buy as much as we can, right? Which is a great time right now to buy, which is, I think, where you're going, right? Is we bought these properties during COVID, right? In the midst of COVID, when people said, hey, listen, you're crazy. And I know, Tyler, you personally got people telling you, you're crazy. What the hell are you guys doing? You know, I know even with tropical, people were like, man, I mean, guys, what are you thinking here, right? You know, people aren't paying rents right now. You know, what are you thinking? And this property, you know, in 18 months, we put this on the market at 15 months only owning it. And people said, no, you got to hold it. You got to hold it. But the reality is we were able to hit 4.5 year numbers in a 15-month period when we put it on the market, right? And I know someone just asked on here, why not hold it? What happens if you want to hold it? Well, the reality is, I think you'll go into this. What's great about the fund that we do is we refinance, we get our money back to put into more properties. That's what, you know, investing is. It's leverage, right? And I know that you'll touch base on that, but it's all about leverage. You know, listen, if I can take a property like a Charbonneau or Tropical, right? And I can double my money in an 18-month period and go put that into, you know, another property. I look at one of our investors on here, Doug, right? Now, Doug, I owe you a phone call, and I know you do. Or I know I owe you a phone call. But, you know, Doug put it into this property, man. And, you know, now he's putting a large chunk of money back into our fund. Why? In an 18-month period to be able to hit numbers like that, right? Investors want to put it in. Why? They saw what we could do during COVID, and they're not worried about what's going on right now.
No, that's it. So I want to answer a couple questions, right? Because we have a couple things in here. Number one, I saw, and I just see some, right? Tony, you had said you would love to jump on the phone with me individually. There's 382 people on this call. Imagine if I had to talk to all 382 people. I would love to talk to you individually, but we have a team for a reason, man. My job is to make sure that we run the company to make sure that we get the returns that you need. My team is very equipped to answer every question that you have. And, you know, and then if you go through them, then maybe we can schedule a call. But understand, man, my job, I'm very clear on what my job is. My job is to run a company to get my investors returns. And I don't stray from that vision. That's how neither does Ryan. That's how we're able to get the returns that we do. And the team members understand their roles, man. We all understand our roles. A couple of the things that I saw on here was that most projections are hold periods of 5 to 7 years, yet you held for an average of 1 year. How much longer can you depend on appreciation rates like we've had? Chip, freaking great to see you on here. Hope Jeannie's doing amazing as well. And the market has been a pretty bullish market, right? And what he means by appreciation rates, you have natural and forced appreciation. Natural appreciation is the market, the demand is higher than the supply. So the rates, so the prices, you know, people are willing to pay more. First off, that supply demand imbalance does not go down. Even with interest rates spiking, understand the interest rates, even though they spike, cap rates don't necessarily just follow that because the demand is absolutely massive. So do I think that it's going to be as crazy as it has been over the last couple of years? I don't. That's why we exited when we did, so that we could, once again, now buy with the new landscape that we're going into now and have a different plan moving forward. Do I still think that there's room for both forced and natural? I mean, dude, not even a question there is. Not even a question. So going through a couple more of these, okay? Not to be a buzzkill. I haven't even read the rest of this, but I always love when somebody says not to be a buzzkill. With returns like these, why are you needing investors? With returns like these, why are you needing investors? I don't even know if I understand the questions. We got returns like these for our investors. We are investors on these properties, but those are the returns we got. How many of you would like to be investors on these deals that we just talked about? Give me a thumbs up or a yes in the chat. So Scott, that's not a buzzkill thing. If we were just using our own funds, we have a very limited ceiling on how much real estate we can acquire. And if you just use your own funds to buy your own deals, you are also very limited in what you can actually do, both time and growth wise. But when we partner together, you our investors bring capital, we bring capital, and we bring our expertise and knowledge, we're able to do the crazy numbers that we are, once again, because we know where our focus is so that we can each maximize what we need to do. That's why we do it that way. So I want to paint this picture as we continue to go, okay? And talk about the Akahi Fund and help you understand the differences here, because, you know, as we go into this, so many people and so many of our investors, by the way, so many of you, a lot of you are our investors, as I see your names, you know, within the chat. This struggle of trying to find or choose the best property. We have all these properties that we're buying. Think about this. We just listed out 4. Yeah, which one is the best? And whichever one is the best, I want to put all my eggs in that basket. Well, let me tell you what happens when you put all of your eggs in one basket. Typically, somebody steals the eggs and the basket, which ain't good. Okay, you need to diversify. You have to learn. You have to understand that there is a better passive way to win. A better passive way to win without putting. There's a way to do that without putting all your eggs into one basket, which is a system which allows you to protect yourself against the downsides, but still benefit from the upside. That's why we structured the fund the way we did. And paint this picture a little bit, okay? If you were to benefit from all of the properties that we just listed instead of just one, the average ARR across the portfolio was a little over 30%. The lowest ARR was 25%. So listen to what I'm saying right here and how diversification can help you, once again, benefit. There's a couple ways. The growth aspect, number one, to help you understand what that would mean, okay? If you would have been able to invest $100,000 in, once again, and to be diversified across all 4 instead of just one, that would be an additional $5,000 per $100,000 that you invested. Once again, growth and protection. You also cash flow consistency. Ryan, we talk about Prosper Fairways we held for 9 months. How much did we distribute in cash flow on Prosper Fairways?
A big goose egg.
$0. $0. The cash flow throughout the whole, that 9 months. Why? Well, because Prosper Fairways, our plan going in, the business plan going in, we had to stabilize. There's a shorter hold, right? But we had to stabilize that property before distributing. The property with the highest cash flow returns, Rivercrest, that was a stabilized asset right out the gate. And so what this allows you to do, if you were to once again invest over all of them instead of just one of them, you have consistent cash flow while still maintaining equity upside. How many of you want to be able to invest with cash flow and equity, both, instead of just choosing one or the other? It's like, right, I always say, right? You have your cake and eat it too. And you know what? It's cake. And Ryan knows that means it's what you're supposed to do. That's a J. Cole lyric. You're welcome. Okay. It's one of my favorites. But you're missing out on a couple things here. Okay. You need to understand a couple more things. Well, one more thing specifically. You have cash flow, you have equity appreciation growth, but then you also have protection. How many of you want to make sure that your investor capital is also, your money that you've worked so hard for is also protected as you're investing? Once again, all these things are very important to long-term financial freedom. The title of the webinar is Financial Freedom. So how do you do that? Well, man, you have a safety aspect that's diversified over multiple properties. And I'll give you an example of this, okay? When we went to, we're getting right to the closing period of these 4 properties that we sold all at the same time. And Ryan, how much did we have to retrade? Retrade means renegotiate, okay? Renegotiate. So how much did we have to renegotiate at the end, right as we were exiting?
Oh, man. It's crazy. I was out in Maui when this happened, right? It was, we retraded. They called us up and they wanted $7 million off of the portfolio sale. That's what you're referring to, right? Yeah.
7 million. 7 million. Do you think that would affect investor returns if we had to renegotiate by $7 million right at the exit? Yep. That would not, it would definitely affect your growth and your protection of the capital. But once again, we know how to structure not only when we buy, but we know how to structure when we exit, which means we didn't have to retrade for 7 million for crying out loud. Now we did retrade at the end for $1 million. You want to know what is funny? 7 million actually made sense. It literally made sense at that point, but we were protected in a way that we didn't have to do that because we know how to exit, not just, once again, buy. And so we were able to renegotiate, retrade for $1 million. And $1 million for you may sound like a lot. And I'm not saying that $1 million is not a lot. $1 million is a lot. But imagine if it was one property, how much that would affect your returns on one property. But over the span of 4 properties with values north of 82 million, the impact was very minimal. Once again, for a couple of reasons. Number one, because we're positioned well. Number two, we understand how to negotiate properly. And number three, because of diversification across the 4. Once again, that's why the fund is structured the way that it is. Safety, growth, protection, all those things that we've just mentioned. So we talked about this being 30 minutes, and I want to make sure that we leave some time for Q&A at the end as well. So I want to talk about the structure and how it's different, okay? Have any of you ever invested in a fund before? Give me a yes or a no. Okay. Okay, a bunch. Okay, a huge mix there, okay? Huge mix there. Okay. So a fund, let me help you understand what that fund structure is, okay? Can I be honest with you right there? I asked you that question, then something went wrong with my screen, and then I totally forgot the question that I asked you. I'm just going to be fully transparent. I put it on mute. I asked my team, son of a gun, what question did I just ask? And Strat from behind the screen tells me what question I just asked. Can we just give Strat? Thank you, Strat. Appreciate that. So just so you know how most people structure their funds, they'll structure syndications like these deals we just talked about. But then when they move over to a fund model, they take all the benefit instead of passing it down to investors. They structure differently. They have bigger carve-outs, bigger ownerships. Why? Because they put themselves in a position with a track record to be able to do that. We can do the exact same thing, but we do not do that. We don't do that because we believe in a win-win. And we believe that as we take care of investors, I want you to understand, we want y'all to invest with us for a lifetime, not one time, a lifetime. But you will invest with us through a lifetime by proper structure and making sure that you benefit as well. It's absolutely massive to it. So Ryan, I want to get into why multifamily, okay? Will you tell them about hedge against inflation, why inflation, where inflation is and how multifamily is a hedge?
Yeah. So, as inflation goes up, so do rents. We were just talking about an article I read, was it yesterday? At multifamily, they're saying through 2023, I believe this came out in Forbes magazine, through 2023 will be one of the strongest investments out there. Why? Because as inflation goes up, so do rents. The reality is this, right? Supply is not really out there in single family homes right now, or you're seeing it's really becoming stagnant, right? At the amount of homes, residential homes that are selling, right? So supply is really not there. You're starting to see a decline, which what happens is people go into apartments because they're not able to afford homes, or lending is too much, right? The capital is too much for them to borrow against right now. So what do? They go out and rent. You take this, and I know we read this article together as well, but Human Resource magazine came out and said, obviously the younger generation, they want to rent. So what does that mean? I laughed. Someone said in here, you bought those properties during the right time. So the appreciation, they appreciated a ton, right? Andrew, I think said that. And I think it's interesting that, that approach, sure, right? But we also bought during one of the highest times as well, right? Here's the thing, just because you buy at the right time, you still have to manage these properties, correctly, and so how do rents go up? How did we continue to increase rents during COVID? I mean, people were not raising rents at all and increasing rents. And that's what I love about inflation. People are going to pay more because of the community that they're in. It's a physical asset, that people like. They want that community. And that's one thing that we focus on.
Hey, one thing that I'll harp on that too, Ryan, is people are like, hey, you just bought at the right time. You're damn right we bought at the right time. You want to know why? Because we're always buying. That's why we bought at the right time. My question is, did you invest at that time, or were you on the sidelines like some of our competitors? Did you benefit like some of our investors, or was it to your detriment, once again, by inaction? So man, it's easy to say, hey, you just bought at the right time. But what Ryan said is a couple things. People never told us it was the right time at that time. Now they say it's the right time. But understand, this isn't our freaking, Oliver just said Tyler is a gangster. You better believe Tyler's a gangster, man. You better believe it. We buy at the right times, and then guess what? We've been doing this for far longer than 2020, man. We started in 2014, and our portfolio is what it is, and our returns are what they are because we not only understand how to buy, but how to operate. We know how to look at multifamily, once again, multifamily fundamentals and understand what to do there, okay? So the supply-demand imbalance, why is there so much of supply-demand imbalance? You have baby boomers, they're downsizing, freeing up some cash. You have, they don't want to take out another mortgage, so, they're moving on to a new chapter in their life. And so millennials, they were slow to form households and, they're scared of the financial crisis, and now they're starting to form households. You got Gen Z who's just entering the workforce. Their savings rate is at some of the most historic lows out there. They will struggle to amass enough money for a down payment of a home. So all of that means these people move towards renting the types of assets that we have. And Gene, I appreciate that, man. Appreciate that a ton. Saying that we're the best operators out there. Amen. But thank you, man. I don't take that lightly. None of us do. But man, I appreciate it. I'm very grateful for investors like you. You've invested with us for a long time. All right. And then we also have, the ability to adjust to market conditions. And that's, it's what Ryan was just talking about. We have this unique thing on multifamily where we can react quickly, but we also can be proactive instead of just reactive. But reacting, what I mean by that quickly is we have these short-term leases. And so assets that have short-term leases, meaning we have leases expiring every single month. And at that, we can react what these rental rates are, right? What those rental rates are. So if, once again, inflation continued to rise, well, what does that mean? Our rents should rise. When our rents rise, once again, what happens to our property values? They also rise. That's why it's a hedge, right? That's why it's a hedge. And then diversification we have on here. Diversification is massive. We talked about that with the, fund and why it's so important, but also understanding diversifying from the stock market. The price of real estate isn't directly correlated to the price of the stock market. The real estate doesn't have these daily price fluctuations driven by investor sentiment, like emotion, if you will, because the properties aren't liquid. The investments aren't liquid, which allows us, once again, to play the long-term game, not just a short-term game, and be proactive, not just reactive. And then Rye, to wrap it up, I want you to talk about how we pay less taxes right now on these investments, and also how we pay less taxes in the future on these investments.
Yeah. So, it's great. I think there's several questions on there that segues into it, is what's the minimum investment? It's $100,000. So let's use that example. We talked a little bit about why we don't do 1031 exchanges. For us, it just doesn't benefit us. We want to be able to save today, right? The value of a dollar today, we don't know what it is in the future, right? So I would much rather take it today. I know, Tyler and I, we talk a lot, and I'm more into the politics than anything, but more than anything, right? It's my job, right? My job is underwriting, and give Tyler, the most data possible to make the best decisions for our company, and so some of the best things out there are cost segregation and bonus depreciation, right? For example, you invest $100,000 with us, most of our investments that we have, you're going to see 50% to 100% of what you invest in depreciation in that first year. So what does that mean, right? Let's say at an 8% preferred return, let's say you get $8,000 in cash flow in your first year. How much taxes do you pay on that $8,000? Did I word that correctly?
Yes, how much in taxes? But listen, first off, we're not accountants. We have to do it. I think we're supposed to do some sort of a disclaimer. We're not accountants. It's not an accountant advice. Not advice on how to do. You should work with an accountant.
All right, let's word it this way. Tyler, how much did we pay on our cash flow last year? On our cash flow,
We were actually zero, but we were actually net negative, meaning we were actually owed a return. And help you understand, we made a pretty good chunk of money. But it doesn't matter how much money you make when it's, once again, offset by the types of things that we're talking about, which is cost segregation, bonus depreciation. Massive. And once again, Ryan, how long does that last for?
Yeah, so Angela just asked that. So it's 100% this year, next year 80%, following year 60%. So this is the last year that will be 100%, of that bonus depreciation.
And just in case you're not feeling urgent, let me paint this picture. When our investors, we just distributed, what was it, 45 million to investors, something along those lines?
Close to 45 million, yep.
Just under $45 million that we just distributed out to investors. We cut checks for 45 million. One of the funnest, it's very fun. It's very, very fun to do that. But to help you understand this, none of our investors did a 1031 exchange because we'd have to do that as a group. But why didn't we do a 1031 exchange? Well, because they can offset that through bonus depreciation. It was attractive. Bonus depreciation, here's the best way to paint this, is attractive enough that they can remove themselves from the 1031 exchange rat race, offset through bonus depreciation, cost segregation, reinvest into the fund, which will be acquiring more properties that have bonus depreciation and more cost segregation to offset future liability as well. So it is that attractive that they benefit from that. And once again, this year is the last year to benefit from 100%. Paint this picture a little deeper. When people are doing 1031 exchanges and they're deferring the taxes, why are they doing that? Well, they're trying to create generational wealth and pass that on to future generations. Well, when you cash out of a 1031 exchange, do you have to pay taxes when you cash out of a 1031 exchange? Yes or no? Yep, eventually you will. And once again, I just mentioned that I believe tax rates will only increase. That's what I believe, which means, let's say you're setting this up for generational wealth for your families, which, I've seen a number of those comments in there. Well, then who really is paying the tax liability at that point if you did do a 1031 exchange? Your family, at a higher tax rate, at a higher dollar number than is currently there. Living trust is great. That's protection. That's protection. But that doesn't mean that you don't pay taxes. I want to be very clear. Living trust is awesome, but tax man will always come. It's understanding how to offset that properly. Bonus depreciation, cost segregation. Bonus depreciation, cost segregation. So it's massive for you to be able to tap into. All of our properties will have that. And then once again, the economy is the last little bullet point I want to have here, because I asked you this question at the very beginning. How many of you in 2020, what was the, economic outlook? What did it look like? Scary, sad? And I asked you, what does it look like now? And all of you, most of you answered the same thing. I need you to understand how our investors, listen to this, how our investors benefited from the fear of others. Other people in June of 2020 were sitting on the sidelines. There's people right now, maybe even some of you, that are sitting on the sidelines. Listen, understand that we have more buying power right now because of interest rates, because there's trepidation in the market. Not only do we have more buying power because of the market and the relationships we have more buying power because of the fund that we have. We can go in and we can negotiate better terms because of the fund that we've structured. And once again, pass that on to our investors. A lot of people, even with bonus depreciation, cost segregation, a lot of people don't pass that on to their passive investors. We do pass that on. Why? Because once again, we want you to invest with a lifetime, or for a lifetime. So I'll wrap up with this, and we'll go into Q&A if this is okay. But I just want to help you understand there's a lot of crazy stuff going on. Dude, interest rates are going up. You have housing prices going up. Taxes are going up. Value of a dollar is going down. You got wages that are freaking flat. You have gas prices that are through the roof. You have Russia-Ukraine situation. Dude, the world's in disarray and confusion. But listen, do not get caught in the disarray and the confusion. Don't get caught in the disarray and the confusion. What you do is you turn your cash into assets that produce income, offset taxes, hedge against that inflation, and once again, help you on the path of generational wealth and, wait for it, financial freedom. Very grateful for the knowledge and the education that we have to be able to provide opportunities like this. Why do we provide opportunities to investors? Why do we use investors? Because we couldn't do it without you guys. We could not do it at the rate that we can do it without you guys. And you couldn't do it without us. That's why it's a synergistic partnership. We can do more together than we could do on our own. And I'm grateful for that. And I hope you're grateful for that as well. I want to make sure that we open it up to Q&A. Ryan, if you have anything else you want to cover there as well.
Yeah, I know you love this question. You know, someone's asked a few times, if they invested $100,000, does that guarantee a return?
Nope. It's an investment, right? It's just like any investment. There's risk. You'll never hear us say otherwise, by the way, ever. Now, our job as operators is to mitigate that risk. But I want to be very clear. Real estate is a risk. Investing is a risk. It's our job to understand how to mitigate the risk. If you remember, our job is to protect, number one, and then grow your capital. Protect and grow your investor capital. That's our job. That's how we structure everything. But everything, I mean, it's a risk. For sure, our job is to mitigate it. Anything else, Rye? Or any other questions? Or
I was trying to catch up with the questions. Yeah. Gene, you just asked a question. I owe you a phone call anyway. I'll reach out to you on yours. That's a little more detail there.
okay, so sorry, I'm just looking at the Q&A, Rye. We have some Q&As that I missed over here. I got it, Jay. Thank you, man.
Would
So
it be
the
more
Q&A,
wise?
one of them is,
Hang on, would it be more wise to invest in Q4 of this year or the first quarter of 2023? And I would say this year, you get 100% of bonus depreciation this year, right? So
This year for
let's
sure.
put that into perspective, right? You know, let's say you invest 100,000 and it's 100%, right? That's $100,000 in depreciation. Next year, it'd only be 80,000. So that's $20,000 less in depreciation that you'd be able to get. So it's a significant amount of money. Awesome. These are
yeah, the Q&As, I think we've answered most of these within there. So I'll just type them.
yeah, David just
live.
asked a
One
great
of them is-
question. Oh, sorry, I keep interrupting. You go ahead.
You're good, bro. No, you're good.
No, David just said, will we get information on the properties that we're going to invest in? And absolutely, David. We're actually taking down, we close on Monday and Tuesday on 2 properties, right? That's going to be Coventry and our Waco deal. So one's in Houston and one's in Waco, both of them in Texas. So yep, you'll get information on all those properties. There's 2 other that are under contract as well. One closes July 22nd, and the other one will close roughly 45 days after that.
One of the questions I have is I have 100% equity in my house, Amy. I have 100% equity in my house. Can I use a HELOC on it? Yes, you can invest with the HELOC. Yes, you can invest with the HELOC, number one. I want you to understand the pros and cons of all your investment options, though. So we'd love to jump on the phone with you and walk you through pros and cons of both of all those options, but absolutely you can do that. Another one was, is this fund similar to Fundrise? No, Fundrise is like I'm talking about with how they structure is very different than how we structure. We structure just like a syndication, which means the upside of a syndication, but it's now diversified over multiple properties instead of just one. But our equity splits, our preferred returns, all those things are the same. Fundrise, very different ballgame there.
Someone asked Tyler, what's the estimate return on $100,000? Most of the properties we look at are 18 to 20% annual rate of return. So you can take a look at that. One of the things that Tyler went over on all of our properties, you saw they were between 18, 19.5% annual rate of return. For us, it's under promise, over deliver. You'll see a lot of operators out there. I can't remember, Ramon, I think you asked that question. You'll see a lot of operators out there that just pump up like market, rates, market rent growth. We don't do that. We're extremely conservative. For example, in Houston, the market rent growth is 10.5%. We underwrite it between 3 and 5%. We're extremely conservative in our projections, which is why the returns that Tyler went over, why you see the returns that we have. We're extremely, in fact, I think, Tyler, I'm probably too conservative sometimes. But
well, in our projections, but I don't even think that that's. Well, I'll tell you, if it was up to Ryan, we probably would have never done a deal yet. It's because Ryan is super conservative. And you know what? If it was up to me, we would have done some deals that probably wouldn't be good deals. So it's a good balance. You know, Ryan's super conservative and I have this solution-based mindset, but bring those two together and been able to accomplish great things. One of the questions that I saw in here is investing in a fund. Are you considered an LP? Yes, is the question, Latasha. And is the investment backed by the property itself? Yes, you own shares within that property. So absolutely. There we go. Do you create the property package? Is that something we have to put together ourselves, or is that something done in-house? Nathaniel, I'm not sure what you're asking there, but you're not creating any property packet. We create property packets, which is just a business plan for our investors so that you know what that is. So yeah, we create that so you know what to invest in or what the investment is. What class of properties are you likely to buy during the rest of 2020? Also the ones under contract, anywhere from C+ at the lowest to B+, right within that realm, and a mix of those, Bob. A mix of those, once again, for diversification. So you have upside cash flow, also upside equity. I'm using these in the Q&A, Ryan. If you have any others.
Yeah, Diva, I think, Diva, you asked, what's the equity exit? Obviously that all depends. On our portfolio, we just sold off. It was anywhere from 20% to 63%. So just on the equity itself. Now that doesn't include the cash flow or catch up or anything like that. So great question on that.
Yes. And Jody said, yes, C+ to B+. Yeah, Angela, no A's. There's just A's are what's going to get A's where the troubles are. Because there's affordable housing is where the true need is, man. Everyone that's building right now, those would be considered A's. Can you use self-directed IRA? Self-directed IRA and still take advantage of the accelerated appreciation feature? That one we'd have to turn over, right, Ryan? Or can you answer that on a?
Which one is it? I'm sorry, will you repeat it?
Can you still benefit from cost segregation bonus depreciation with a self-directed IRA? I can't answer that properly on my end.
I mean, I could answer it, but I would go to your advisor on that one.
Well, we can connect you to an accountant to help you with that too. I see Tina, great to see you on here, by the way. Are you investing in this fund as a GP? Yeah, absolutely. But as we invest our money, we're considered, so look at it this way. When we're investing the operations at our time, we're considered a GP, a general partner, but we're also investing our money into the deal as a limited partner. Okay, sweet. Give me 1 second. Let me answer this one real quick. Bonus depreciation and accelerated recapturables. So on liquids, I'm fine. What kind of? I'm not sure how to answer that one, but I think that you're asking, does it help you offset cash flow and equity gains? The answer is yes. A 1031 buyer could not invest in this fund as a replacement property, correct? If you have a current 1031 exchange, we'd probably send you a different direction. But once again, that's something that we would want to talk to you individually about. It depends on what size that is. And then Jackson, what was the question you said?
Diva asked, a little direct, can you tell me about your worst investment, how you guys managed to pull through and get money back to your investors?
Yeah, our worst investment. You mind if I take this, Ryan?
Yeah, go for it.
I don't know if it's worst. Our toughest investment is one that we actually just exited as well. It's a property called Village East. It was a very tough investment. We bought that right before, end of January 2020. And the plan, think about this, the business plan was to evict. I want you all to listen. This question is a very good question and one that is going to open your eyes a ton. We bought in 2020 with a business plan, listen, to evict tenants. And if you don't think about what happened in 2020, March of 2020, right after that. What happens right after that? An eviction moratorium. An eviction moratorium, which means we cannot evict through the eviction, legal, normal eviction process. Do you think that would impact our business plan? Yes or no? Village East, my first investment. Neil, absolutely, man. Neil can attest to this. A number of you, we have, a couple of you that were on there. Yeah, definitely. Okay. Chip and Jeannie were on this one. I think Gene, you may have been on this one as well, but paint this picture. Right after that, we had a fire that burned down an entire building. That would not be ideal either. Okay. This was in Denton, Texas, but no matter where it impacts, if you cannot evict, and no matter where, that was nationwide. Now, then it obviously different cities had different restrictions, but it was nationwide at that point. But what we were able to do, there was a number of issues on that property, problems on that property. But when Ryan talks about being solution-based instead of problem-based, a lot of people, think about this, do you think that there's a lot of, I want you to listen once again, because this will impact once again the safety and the growth of your investment. Do you think there's a lot of people at that point that would blame coronavirus, blame the current economic environment? A lot of people. But we didn't blame, we focus on solutions. We focus on controllables. We drive the value up. We bought that property for $12.25 million, sold it off 2.5 years later for $18.1 million. And this is where I want you to listen. If we would have went with our operating agreement, now those numbers sound really good, 12.25, 18.1. We projected returns to our investors of 19%. If we would have went with the operating agreement and done the splits according to the operating agreement, our investors would have received 13% annualized returns, 13%. But Neil and Jeannie and Chip, those of you who aren't here, can attest that you didn't receive 13%. Why? Because listen to this, we gave 100% of the profits to our investors to get them to 18% returns. That still is under what we projected. It's it was one of the only properties in our entire portfolio that we've underperformed. Why would we give 100% of the proceeds to investors to get them as close to that projection as possible? Well, because it is, so they can reinvest, but it's a long-term, once again, lifetime. We want you to invest for a lifetime. It's a long-term play, a long-term strategy, not a short-term strategy. We want you to invest with us for a lifetime, man. And that's why you see Neil, Chip, Jeannie on here. It's because, man, we want you to get returns. So you'll be hard pressed to find any operator who would give 100% of returns to investors and get them to an 18% return and still be we're not happy as operators that we didn't hit 19, because our MO is to not just meet but exceed our return projections. That was the toughest property that we did. You're welcome. All right, we have maybe a couple more. I know we have a ton of questions. I can't necessarily keep up. I don't know if Ryan or anybody else has seen some of those that you want to. Or that you think we should answer. Rick, man, great to see you on here, my man. Absolutely, we'll send out the replay to you, brother. It sounds like you missed a little bit of it. Absolutely, we will. So I hope you understand one of the questions was on the exit strategy of the fund. Okay, now here you go. This is actually another great question because it's something that you'll really appreciate. Okay, when we go to exit, the plan on exiting with the fund is, first off, there'll be longer hold periods, but what we'll do is we'll refinance, okay? And when we refinance and we get you, let's say we refinance and we just get you your initial investment back, okay? Well, that is a return of capital, which means that is not a taxable event, which means when we refinance, we give you, let's say you invest 100,000, refinance, give you your initial 100,000 back, okay? Not a taxable event. So what do you want to do with that money? Obviously, we will have another fund for you to reinvest in. But to help you understand what that would mean with the Akahi fund, or whatever fund you would invest in, you would still own the same percentage of ownership within the fund. You'd still benefit from the same cash flow growth, the same equity growth, but your initial investment is now into something else, which is also now growing, which means your rate of return on that initial investment, once we refinance and give you that initial investment back, but you still maintain ownership, well, what's your rate of return on that? If you don't have money in, but you still participate from all future equity and cash flow. More than 100. Trisha, good to see you on here too. Infinite. But the SEC does not allow us to say infinite, nor would we ever project infinite. We would project 19%, 18%, because we're conservative. Infinity and beyond. I like that too. But yeah, that's how the structure is. That's how the exit is on those. And that's the plan there. Okay. Jackson, Ryan, anybody else, anything else we need to answer here? I know we tried to answer as many of them as we could. I hope that we got all of those. You're welcome, Gail. You're absolutely welcome. Mahalo. Mahalo to you as well. I love it. All right. Hey, love y'all. Thanks so much. If you have questions, once again, we'll throw the link in the chat. Feel free to reach out. We want to make sure that all your questions get answered. You can absolutely reach out, schedule a call. We'll get you all squared away. I look forward to having you all invested within the fund and let us know how we can help. So thanks so much. Once again, please reach out for questions, please. We want to make sure that we get you all taken care of. So any sign off, Ryan? Anything else you want to say as you sign off?
No, just like, listen, we're looking forward to you guys. Hey, listen, we have a great team out there, you know, in Melissa and Tasha, and so they answer any questions. I know that you said some people have some 1031 questions. Listen, those girls are great at answering those questions of why we do cost segregation. So I would recommend scheduling some time with them. They're amazing at what they can answer.
Yep. And if we can't, we're going to tell you, just like today, we can't answer it the best, and we'll refer you to a team member that can. That's what's beautiful about a team. So thanks so much, y'all. Hey, have a great rest of your
really quick,
week.
Tyler, I know that someone said something. I'm not sure if you said something, but someone asked where we at or how much is available. This is a $30 million fund. You know, right now, I believe we're at about 23 or 24 million. I think we'll have 5 million left, and it's going pretty quick. So I'm not sure the updated number on that, but I think that's right around there.
Yeah. And those shares are definitely first come, first serve. So once again, you can reserve those. We'll send a link your way as well for you to be able to do that. So thanks, y'all. Appreciate you spending an hour with us. Once again, reach out if you need anything else. Thanks so much.